Hello, my name is David Davis, and I'm the managing member here at GoRobinhood.com. Welcome to the video Municipal Bonds. In this video, we're going to talk about what municipal bonds are and how they work, and we're also going to walk through the key calculation that'll help you determine if municipal bonds are right for you. What are municipal bonds? Municipal bonds, they're often called munis, are debt securities, bonds, issued by a government entity such as a state, municipality, or county. They are issued to help finance capital expenditures of the issuer, things such as hospitals, schools, bridges, and infrastructure projects. Municipal bonds are always exempt from federal income taxes and often exempt from state and local taxes as well, especially if you live in the state where the municipal bond was issued. There are two primary types of municipal bonds. The first is general obligation bonds. These are often called GO bonds, and these are backed by the full faith and credit of the issuer. General obligation bonds are paid back through taxes collected by the issuer. The second primary type are revenue bonds. These are backed by the revenue in which the capital expenditure or project is designed to produce. A great example of a revenue bond would be a toll road. How are municipal bonds purchased? They can often be purchased directly from the issuer. They are most commonly purchased, however, on the secondary market through a broker-dealer. You can also purchase a municipal bond fund, such as an ETF or a mutual fund, which is, in my opinion, the safest method to gain exposure to an entire basket of municipal bonds with instant diversification. You will own shares in the fund, while the fund itself will create a well-diversified group of municipal bonds from many issuers. Keep in mind that funds help diversify your investment, which reduces risk and also allows for greater exposure for much less capital. The primary characteristics of municipal bond investors are high income earners and conservative. The tax equivalent yield is the key factor in your decision. Even though municipal bonds are free from federal taxes, the interest rates paid to investors are much lower than the rates of taxable bonds, such as corporate bonds. Think about it this way. If municipal bonds paid the same interest rates as other bonds, and they were tax-free as well, then investors would only buy municipal bonds and other bond types would likely not even exist. Like everything in investing, there is always a trade-off: risk versus return potential, credit rating versus yield, and in the case of municipal bonds, we are comparing a lower tax-free yield to a higher taxable yield. What exactly is the tax equivalent yield? The tax equivalent yield is the yield that a taxable bond must equal or exceed to create a greater net return for the investor. This is a very easy calculation, and we're going to walk through a few examples. Here is the formula. Tax equivalent yield equals the tax-free muni bond yield divided by 1 minus the investor's tax rate. Sounds a little confusing at first, but it's actually a very easy calculation. So let's go ahead and walk through it now. Let's say that John is considering investing in a municipal bond that currently yields 2%. That is his tax-free yield. John is in the 35% tax bracket. He also has a second choice, which is to buy a corporate bond that is currently yielding 4%. So let's plug in the numbers and work out this calculation for John. We're going to take his tax-free muni bond yield of 2%, and we're going to divide that by 1 minus John's tax rate, or 0.35. And the answer there is 0.65. So if we divide 2 by 0.65, we get an answer of 3.08%. And this is John's tax equivalent yield in this case. John would need a taxable yield greater than 3.08% for it to make sense to buy the taxable bond. In this case, the taxable bond is yielding 4%, which is greater. So the conclusion here, John would be better off buying the taxable bond. We're going to walk through one more example. Mary is comparing a municipal bond fund that is currently yielding 1.85% to a corporate bond fund that is currently yielding 2.55%. Mary believes that these two bond funds are similar in other ways, such as average credit ratings and average maturity dates. Mary received a raise last year and is now in the 35% tax bracket, just like John, and has no state taxes in her state. So we're going to walk through the calculation for Mary. Mary's tax equivalent yield is going to equal her tax-free yield, 1.85%, divided by 1 minus her tax rate, 0.65, And the answer in this calculation is 2.85%. So Mary needs a taxable rate greater than 2.85% to choose the taxable corporate bond fund. The corporate bond fund in this case is only yielding 2.55%, so the conclusion in this example, Mary will have a greater net return by investing in the municipal bond fund. Apples to apples. It's very important to consider all of the relative aspects of the two bonds or bond funds being compared. These aspects include things such as the term or maturity date, the credit ratings, and are the bonds callable or not. A callable bond will almost always pay a higher yield to investors because the issuer has the right to call that bond back at any point. The tax equivalent yield will give you an exact yield comparison when using two comparable bonds, but any inconsistency should be considered and factored into the decision accordingly. Don't forget about state and local taxes. If you are considering a municipal bond that is also tax-free in your state, then you should add the state tax rate, if applicable, to the calculation. Here's an example. If your federal tax rate is 28% and your state tax rate is 6%, and the muni bond you are considering is also state tax-free, then you should use a total of 34% or 0.34 as your tax rate in your calculation. Divide the muni bond yield by 1 minus 0.34 or 0.66 to achieve your tax equivalent yield. We hope that this video was helpful with the decision process. We would like to invite you to come by and visit us at www.gorobinhood.com for other great educational videos and also to learn about our money-saving investor services. I want to thank everyone for watching and have a great day.